Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing. Imagine you're at your favorite local spot, maybe a cozy cafe or that bustling pizzeria down the street. You see the staff just zipping around, taking orders, handling payments, even managing inventory, all on these, sleek digital tablets.
It's everywhere now.
It feels seamless, really efficient, almost like magic sometimes. But what if that same technology, the system making your meal so smooth, isn't just about helping small businesses?
Okay.
What if it's quietly forging these massive alliances with industry titans, like completely reshaping how a huge industry operates, not just for the independent spots, but for the major restaurant chains across the whole country?
That's a big shift.
Exactly. Today, we're going to unravel the story of TOST, the company behind so much of this digital transformation in restaurants. We're asking, what does this accelerating wave of partnerships truly signal to you, the individual investor?
Right. What's the real meaning behind the headlines?
What does the future really look like for this company? Because this isn't just about, a few new deals popping up. It's about understanding if these collaborations are building a foundation for explosive growth or if they're maybe just fleeting trends in an incredibly competitive landscape.
Yeah, very competitive space. Absolutely.
We know you've likely navigated the challenge of spotting the next big opportunity or maybe avoiding an investment that was, overhyped.
It's tough out there.
So stick with us. By the end of our conversation today, you should have a much clearer picture of whether TOST is really poised to become a powerhouse in your portfolio, or if maybe it's a story that calls for a bit more caution. We'll look at its leadership, its journey through financial ups and downs, and the strategic battles it's fighting right now in the market.
Sounds good. A lot to unpack.
Definitely. So to truly grasp where a company is headed, we absolutely have to begin by looking at who is steering the ship. Let's start by unpacking the core leadership team at TOST and the vision that really propels them.
Absolutely. Leading the charge, you've got Aman Narang. He's a co-founder and the CEO.
Yeah.
His background is as an engineer, originally from Endica, that was a tech company Oracle eventually bought. And that background was, foundational.
How so?
His early decisions, especially that really pivotal move to integrate payments directly into TOST's core platform that has just profoundly boosted their revenue.
Embedding the finance part.
Exactly. It was a strategic masterstroke, really. And we're seeing it pay off in huge ways now, like that big 2025 partnership with Dine Brands.
That's the Applebee's deal, right?
That's the one. TOST's point-of-sale system is being rolled out nationwide across Applebee's. That's not just another contract. It's a massive industry-wide validation.
Okay, so Narang is key. Who else is driving things?
Then there's Steve Fredette. He's another co-founder and the company's president.
Yeah.
Also came from Endica.
Same background.
Right, and he brings critical operational expertise. He's been really instrumental in key initiatives like the recent launch of TOST IQ.
TOST IQ, that's their AI, right?
Exactly, an artificial intelligence engine designed to personalize restaurant operations and, crucially, enhance the scalability needed for these huge partnerships.
Makes sense. And the third founder?
Jonathan Grimm. He's the CTO, the Chief Technology Officer. He's really the mastermind behind their tech innovation. His work on the deep vertical integration of hardware and software was absolutely crucial in landing major deals. Think Topgolf adopting their enterprise solutions.
So it's a very tech-focused founding team.
Absolutely. You see this cohesive, deeply aligned technical vision across all three of them.
What about beyond the founders? Any key board members we should know about?
Definitely. Their board adds significant strategic depth. Deval Patrick, for instance, the former governor of Massachusetts.
Oh, interesting.
Yeah, he provides invaluable policy insights. Super important for navigating the complex world of fintech regulations.
Okay, imagine.
And then there's Paul Bell, who's an ex-Dell executive. He brings serious strength to their supply chain strategy.
Which is vital if you're dealing with hardware.
Absolutely critical. So for you looking at this as an investor, this whole leadership team, especially through their tech-forward decisions like pushing into enterprise with Dine Brands, it signals a team that's not just good at capitalizing on partnership momentum.
They're actively shaping it.
They're actively engineering TOST to be resilient against future disruptions. They're really building for the long term.
That makes a lot of sense hearing how their expertise fits together. So it's not just who they are, but that they're still deeply involved day to day. How does that active founder involvement really impact things?
It's a huge factor, often kind of overlooked. TOST is still very much actively founder-led. Narang, Fredette, Grimm, they are deeply immersed in daily decision-making.
So they're not just figureheads.
Not at all.
Yeah.
They're hands-on. And this kind of active, committed leadership often correlates with that performance edge you see in founder-driven companies.
Any evidence of that at TOST?
Look at their Q1 2025 results. Impressive 24% revenue growth, even when the broader restaurant industry was facing some pretty serious headwinds.
Wow, okay.
That's a testament to their guidance, I think. Plus, they have serious skin in the game.
Meaning they own a lot of stock?
Significant equity. It directly aligns their incentives with yours as an individual investor. They're focused on long-term value, not just, chasing short-term pops.
Right.
Think about Narang pushing for that Dine Brands partnership. That shows a really strategic pivot, turning early challenges they had in consumer payments into this powerful fintech presence that's now core to their growth.
So they learn from early struggles.
Absolutely.
Yeah.
Now, sure, founder influence might dilute a little as they scale and maybe make acquisitions, but their track record is consistent. And critically, you don't see excessive insider selling.
That's a good sign.
It's a very positive signal. It suggests real confidence from the top.
Okay, so leadership is clearly foundational. What about the bigger picture? Their mission, vision, the culture they've built. How do these tie into that growth strategy, especially with partnerships?
Their mission is, well, it's both super clear and incredibly ambitious. Empower restaurants to delight guests, do what they love, and thrive.
Simple, but powerful.
Exactly. It aims to position TOST as the kind of indispensable operating system for this massive trillion-dollar global restaurant market. It's a very clear North Star for them.
And the vision, where are they headed?
The future for them is dominated by AI and deep integrations. You see this clearly in their 2025 roadmap for TOST IQ.
Right, the AI engine.
Yeah, focusing heavily on automated insights for operations. It shows they're not just reacting, they're trying to actively shape the future of restaurant tech, anticipating needs.
And the culture, you hear about Toasties.
Right, the Toasties values, they emphasize humility and innovation. And they try to align employee behavior through practical things like equity grants, internal hackathons.
Hackathons? Really?
Yeah, apparently features like digital order chits actually came out of those events.
Huh.
So this culture, it supports their bold goals, like hitting 100% U.S. market penetration through partnerships. The challenge, of course, is execution.
Always the challenge.
Will that momentum from Dine Brands translate globally? Or will they hit cultural gaps internationally? That's the question. But so far, high employee retention suggests the culture is working. It's propelling their vision, especially through these crucial partnerships.
Okay, so a strong internal foundation. Every successful company, though, has a story of adaptation, right? Strategic pivots. TOST's journey seems like a prime example. Let's trace that path from, well, a basement startup to where they are now.
It's a great story. It really begins in 2011, literally in a Boston basement, founded by Narang, Fredette, and Grimm.
The same team.
The same team. But what's interesting is their first idea was actually a consumer payments app.
Not restaurant tech.
Nope. And it didn't quite take off. But that early experience led to a crucial, really insightful pivot into restaurant technology, right when mobile ordering was starting to gain steam.
Perfect timing.
They saw the opportunity and seized it. From there, they hit key milestones pretty quickly. 2012, launched their Android POS system.
Okay, the core product.
Right. 2018, raised $101 million in Series C funding, clear investor confidence.
Yeah.
Then 2021, the IPO. $20 billion valuation, even while navigating the pandemic disruptions.
Quite a ride. What about the financial growth itself?
It's been pretty remarkable. Revenue surged from about $665 million in 2019 to over $5.2 billion in the trailing 12 months up to 2025.
Wow, that's massive growth.
It's a 49% compound annual growth rate. Huge. And locations grew 25% year over year, hitting 140,000. These aren't just numbers. They reflect real powerful market expansion.
And you mentioned resilience, adapting.
Absolutely. During COVID, they didn't just survive, they innovated rapidly. Contactless ordering solutions that boosted their average revenue per user by 20%.
Turning a crisis into an opportunity.
Exactly. Even early issues like some hardware glitches led them to strategically vertically integrate. And now that integration is a major competitive barrier.
Making it harder for others to copy.
Very hard.
Yeah.
Their market share, now around 16% of U.S. restaurants, shows this resilience. And partnerships, like that 2025 Dine Brands deal, the Applebee's rollout. These are concrete examples of those reinventions paying off. It positions them for future enterprise dominance.
A real story of evolution. Okay, let's dig into the nuts and bolts then, the core mechanics. How does Toast actually make money? What exactly does it offer? How does it manage these huge operations? This gives us crucial insight for investing.
Right. So fundamentally, Toast is a cloud-based platform. It's the digital backbone for a restaurant. POS, payments, operations management, everything.
Like a complete operating system.
Exactly. Think of it as a comprehensive digital ecosystem, simplifying incredibly complex processes into one unified system, sort of like an iPhone for restaurants, everything integrated.
And the money part, you mentioned embedded finance.
That's a crucial nuance, key to their model, embedded fintech. Toast earns a small percentage, say 0.3% to 0.5% per transaction, on a massive volume of payments.
How massive?
Over $42 billion processed quarterly.
42 billion? Wow.
Yeah. So this model cleverly combines the predictability of SaaS subscriptions with the variable transaction volume from payments.
Best of both worlds, maybe.
Kind of. For you, the investor watching these partnership signals, the model's complexity is its link to restaurant health. But Dine Brands adopting it shows the scalability is definitely there. It can handle huge clients. But, broader economic risks are still a factor to watch.
Okay, that clarifies the engine. But in such a crowded market, what truly makes Toast stand out? What's their unique edge?
What really sets them apart, their hedgehog concept, if you will, is that singular, unwavering focus, excelling specifically at restaurant-specific vertical saws, combined with that embedded fintech.
They're not trying to be everything to everyone.
Exactly. They cultivate this deep passion, this understanding of hospitality, and their economic engine is driven by predictable recurring revenue, 80%. From payments and subscriptions.
How does that compare to, say, Square?
Square is much broader. Toast's all-in-one ecosystem, POS to payroll, creates this powerful flywheel effect. More users mean more data.
Which improves the AI, Toast IQ.
Right, making the platform smarter and more valuable for everyone. That potential pot-belly integration we might see in 2025. That just exemplifies how their specialized model uniquely scales chains. It signals a future where their competitive advantage just keeps widening.
Specialization as a weapon. So how do they get these products out there? What's the distribution strategy? How do partnerships fit in?
They use a hybrid go-to-market strategy. For those big enterprise deals like Dine Brands, they have dedicated field sales teams. High-touch, relationship-based.
Makes sense for large clients.
For smaller and medium businesses, SMBs, they use more scalable inbound and self-serve methods. Online demos, things like that.
Efficient. Any other channels?
Yeah, some innovative stuff too. Partner ecosystems with integrators like Grubhub, these really enhance scalability, and their data shows in-person conversions are 3x higher through those channels.
Interesting.
So this multi-pronged approach supports engagement across all 140,000 locations, driving that 25% year-over-year location growth. It's clear. Partnerships are dramatically amplifying distribution, suggests a future dominated by these chain alliances.
That hybrid model sounds effective, but in a potentially volatile market, how predictable is Toast's revenue? What kind of stability can investors expect?
They boast about 70% recurring revenue. That's impressive.
Where does that come from?
Mostly stable sources. Subscriptions, generating around $66 million quarterly, and long-term contracts. This high recurring percentage really stabilizes their finances, even with variability from transaction fees tied to that huge payment volume.
So the big deals lock in revenue.
Exactly. Multi-year deals like the one with Dine Brands don't just add customers. They ensure predictability. They really impact their long-term stability. Their net retention rate is consistently over 110%.
Meaning customers stay and spend more.
Precisely. For you, the investor, this signals that partnerships act as vital buffers against market volatility. It makes Toast's future look considerably more stable.
Good point. Let's shift to the products themselves. What are the core offerings driving this penetration? What's new? And what's on the roadmap, especially thinking about future partnerships?
Well, the product suite clearly has strong product market fit. 140,000 locations, 31% annual recurring revenue growth. The market likes what they offer.
So what are the core pieces?
It's comprehensive. POS hardware and software, payments again, 80% of revenue, online ordering, payroll, restaurant-specific marketing tools. It's designed as that all-in-one solution.
The digital toolkit for restaurants.
Exactly. And they're constantly innovating.
Yeah.
Q1 2025 saw the launch of TOST IQ, that AI engine for operations,
Right.
and the menu price monitor for pricing analytics. TOST IQ is already showing efficiency boosts in pilots, which directly ties into why chains like Dine Brands adopt it.
So innovation drives adoption. What's next?
The 2025 roadmap focuses on international expansion. Ireland and India are targets, plus further AI enhancements like predictive inventory. They're also investing in new services, maybe voice ordering integrations, aiming for broader applications.
And partnerships fuel this.
Through these partnerships, the products signal this future of integrated, AI-driven restaurant ecosystems. It gives you, the investor, a clear vision of sustained innovation and market leadership.
A continuous innovation pipeline. Now, operationally, how does TOST manage this global footprint, and how does that vertical integration strategy play into efficiency?
They're headquartered in Boston, but operations are global. Engineering in Dublin, product development in Bangalore, India,
A global tech setup.
and a new 55,000 square foot manufacturing facility in Spain just for their hardware, plus U.S. sales hubs in major cities.
How do they manage it all? Lean.
Interestingly, yes, they lease most facilities and outsource hardware manufacturing to partners. But crucially, they keep all software development in-house.
Smart focus.
This lean structure supports that partnership momentum, like the Dine Brands rollout. But it's worth noting, it does expose them to lease risks if the economy gets choppy.
And the vertical integration. How unique is that?
It's a critical differentiator. Unlike competitors relying on third parties, TOST uniquely controls its POS hardware, its software, and its payments.
The whole stack.
The whole stack. This cuts cost, contributing to that 49% gross profit growth, and enhances efficiency. Think about Applebee's kitchen display system implementation. That integration is key.
What about supply chain resilience?
Strengths include diversified hardware suppliers. But vulnerabilities to chip shortages exist, though they try to mitigate with stockpiling. Compared to, say, Square, TOST's integration generally leads to a better customer experience, hence that 110% net retention. It suggests partnerships amplify this resilience.
Okay, that makes sense. In a market this crowded, understanding the competitive edge, the moat, is paramount. Let's really unpack the layers of TOST's moat. What truly sets it apart and protects its position?
Right. The market is what we call monopolistically competitive, fragmented. Players like Square, Lightspeed, but no single monopoly.
Where does TOST fit?
TOST holds about 16% market share in the U.S. That's significant. And it's protected by its deep specialization. This focus allows them to get decent 3% profit margins despite the competition.
And partnerships strengthen this?
Actively building the moat. Deals like Dine Brands are positioning TOST for potential oligopoly-like dominance in the enterprise segment. They're carving out a powerful niche.
What other advantages do they have? Scale.
Immense benefits from economies of scale. Larger operations reduce cost per unit. Processing $42 billion in payments lowers their fees significantly compared to smaller rivals.
Right.
Their 140,000 locations enable that 49% gross profit growth, outpacing peers. This cost advantage powerfully amplifies the positive partnership signals, forecasting a future of cost efficiency.
You mentioned the flywheel effect earlier, network effects.
Absolutely. The platform thrives on network effects. More restaurants joining enrich the data for AI, like TOST IQ, increasing value for everyone.
You see that in the growth.
That 25% year-over-year user growth illustrates it perfectly. Case studies show restaurants getting up to a 20% revenue lift after adopting TOST. Partnerships just accelerate this, signaling a rapidly expanding, increasingly valuable network.
What about their positioning against competitors?
Their counter-positioning is strong. Being restaurant exclusive makes it incredibly hard for generalists to replicate their deeply integrated solutions, like embedded payroll.
The market seems to agree.
The fact that Dine Brands chose TOST over others validates its enterprise fit. That specialization is a huge barrier.
And once a restaurant is using TOST, is it hard to leave?
Very high switching costs. Migrating data, retraining staff, it's a major hassle and expense. That 110% retention rate proves customers are locked in. They don't leave easily.
Branding plays a role too, I imagine.
Definitely. TOST's brand fosters loyalty through trust that 99.9% uptime is key, and it supports premium pricing built on consistent innovation.
Do they have unique assets, cornered resources?
Yes. Things like patents on POS integrations, a top-tier talent pool of 5,700 employees, strategic partnerships like Topgolf. They attract talent effectively with equity and mission, hard assets to replicate.
And their internal processes.
Refined processes, like the AI-driven operations, create cost advantages that are hard to copy. That's process power.
Technology itself.
Their proprietary tech is significantly better integrated. TOST IQ's efficiency gains are designed for transformative performance.
Timing was mentioned earlier.
Perfect timing. Riding the digital shift post-COVID, leveraging contactless, huge first-mover advantage.
And they move fast.
Speed of execution is key. Rapid launches like TOST IQ in Q1 2025 outpace rivals, discouraging competition through quick adaptation.
Anything else specific to their industry?
That embedded fintech again, 80% of revenue, uniquely monetizing payments. And partnerships signal vast untapped potential there.
Okay, a formidable moat. So with that strong foundation, what are the main avenues for future growth? Let's explore the strategy, the potential, and the huge market they're chasing.
Their growth strategy is clear and multifaceted. Market penetration via SMB expansion, yes, but also a major push into enterprise accounts. Dine Brands is the prime example.
Plus product development.
Continuous product enhancements, especially with AI. Key drivers are that 25% location growth and the 5% increase in ARPU. Partnerships are unequivocally fueling this, hinting at accelerated future growth.
What's the ultimate potential here?
Opportunities are substantial. Expansion into new international markets, currently just 10% of revenue. Huge potential there. New products like voice ordering. Strategic M&A, maybe more potbelly-like deals.
What are the risks to that growth?
Market saturation in existing segments is the main one, but the rewards could be massive. Think Shopify's 30% CAGR. Their past successes, like the COVID pivots, bode well for future execution.
How broadly applicable is TOST? Just restaurants?
It's niche in hospitality, but the underlying tech is scalable. Could potentially extend to broader retail. High reach potential and partnerships significantly expand those applications.
What's the size of the market they're playing in?
The total addressable market, or TAM, is staggering. Over $100 billion in the U.S. for software and payments alone.
And globally.
A staggering $1 trillion globally. There are about 860,000 restaurants in the U.S. TOST is about 16% now.
Is the market itself growing?
Projected to grow at a 20% CAGR to 2030. And TOST, via partnerships, is positioned to capture a much larger share of that expanding pie.
So summing up the key growth drivers.
1. Partnership expansion, like Dine Brands. 2. AI and product innovation. 3. International market push. 4. Fintech monetization. 5. More enterprise wins. Those 5 are set to propel them forward.
Got it. Now, no investment is risk-free. Resilience is crucial. How robust is TOST against potential storms? And how does the macro environment affect them?
On supply chain diversity, they are diversified, but still quite U.S.-centric. Vulnerabilities exist in hardware supply, chip shortages, but they actively mitigate with multiple suppliers, stockpiling. They're aware.
Customer diversity.
That's a strength. Broad base, SMBs to large chains, various geographies, 140,000 locations reduce reliance on any single client. Boosts stability.
Could their moat erode?
It's sustainable through innovation, but could theoretically be challenged by new entrants or disruptive tech like blockchain payments. But their integration makes it very difficult.
You mentioned anti-fragility earlier.
Yes, they demonstrate it. Getting stronger from stress. COVID spurred new digital tools, led to 37% revenue growth. They adapt and emerge stronger.
How about long-term relevance? Longevity?
They align perfectly with secular trends, digital transformation, AI, and hospitality. TOST IQ capitalizes on this. Their products are highly likely needed long-term. Maybe an 80% probability digitization is inevitable. Recurring revenue helps weather downturns.
Main risks to growth, then?
Potential U.S. market saturation as they grow and competitive pressure from rivals like Square.
Any specific risks? Known unknowns?
A known unknown is inflation potentially squeezing restaurant margins, hitting their clients. An unknown unknown could be broader geopolitical fintech disruptions. Unpredictable stuff.
How do macro factors like interest rates play in?
Rising rates could increase borrowing costs on their $350 million facility. But their huge $1.5 billion cash position minimizes that impact significantly.
Trade.
Inflation.
Global trade helps their hardware supply chain for expansion. Inflation squeezes margins, currently 3%, and demand. But TOST's pricing tools help their clients adapt.
Any company-specific macro risks?
Restaurant slowdowns in a recession could hit their gross payment volume. But again, those partnerships provide a crucial buffer, making them less susceptible than maybe they once were.
Okay, let's finally talk numbers. The bottom line, what do TOST's current financials tell us? And how should we as investors Think about valuation right now.
Q1 2025 financials were really compelling. Revenue hit $1.337 billion, up 24.4% year over year.
Strong growth.
Signals robust demand, definitely boosted by partnerships like Dine Brands driving enterprise adoption, showed resilience, and profit margins expanded to 3.03%.
So profitability is improving, reflects improved operational efficiency. It illustrates that transition from earlier losses to converting growth into profitability. It's happening.
How about metrics like the Rule of 40?
They're at 27.43%, growth plus margin. Not lead 40% yet, but steadily approaching SaaS excellence. Validates product market fit and discipline.
Return on invested capital.
Around 8%. Suggests smart capital allocation, especially in those AI investments driving future deals.
And their balance sheet. Cash. Debt.
Remarkably strong cash position, $1.5 billion. Very low debt. Debt to equity is just 0.06. Liquidity is robust, current ratio above 2, gives them firepower for opportunities like Potbelly or acquisition.
Are there positive signs?
Book value grew 15% year over year, showing long-term value creation. And free cash flow surged to $37 million quarterly. Huge improvement from negatives, freeing up cash for innovation.
What about those industry-specific metrics? Locations, ARR, GPV?
All strong. Locations up 25% to 140,000. Annual recurring revenue up 31% to $1.7 billion. Gross payment volume up 22% to $42.2 billion. These clearly show partnership momentum translating to bottom-line wins.
How does Toast really stack up against its peers in the market based on these numbers? And what have the recent trends revealed?
Compared to peers like Square, with a price to sales of maybe 2x, or Lightspeed with 1% margins, Toast's 5.45 PS and 3% margins highlight its strengths in scale and focus.
But profitability lags some leaders.
Like someone like Shopify with 15% margins, yes. But critically, those strategic partnerships significantly elevate Toast's performance above many industry averages. Shows the power of their differentiated approach.
And the trend over time.
Revenue growth has moderated, yes, from highs around 60% down to 24%. But crucially, profitability has turned consistently positive during that time. Signals maturing efficiency, a shift to sustainable operations.
What's the implication for investors?
A more sustainable, predictable future, provided these partnerships continue driving those positive trends and expanding their footprint.
And what are the current events really influencing Toast right now? And what's the buzz among investors, especially individuals on social media?
Recently, the big things were that strong Q1 earnings beat the $1.337 billion revenue and the ongoing Applebee's deal rollout.
What's coming up?
Q2 results are expected August 5th, and investors are watching closely for that potential Potbelly tech integration predicted for 2025. Enterprise wins are key signals people are looking for.
And the sentiment out there.
As of late July 2025, individual investor sentiment on social platforms is largely positive, maybe 70% bullish. Lots of praise for recent 52-week highs, a feeling it might be undervalued given the growth.
What are they focusing on?
Partnerships driving price targets, often around $60. Talk of bull flags, signaling breakouts. While some worry about valuation, the dominant narrative is optimism around AI and new deals. You see fun comments like, tastier than French toast, filtering out noise to focus on perceived potential.
Okay, let's get to the critical question. Valuation. What's the current price? And how should investors approach valuing Toast, especially thinking about margin of safety?
Right. As of July 29, 2025, Toast, ticker TOST, is trading at $39.06 per share.
And margin of safety. Remind us why that's so important here.
It's critical for any investor, especially with growth stocks. It means buying an asset below what you think its intrinsic value is. Creates a buffer, a cushion, against errors or downturns.
Like insurance.
Exactly. If you think it's worth $100, buying at $70 gives you a $30 margin. Vital for Toast, where the success of that ambitious partnership strategy, while promising, could face bumps. It provides protection.
Why does valuation itself matter so much?
Helps you decide if TOST is over or undervalued. Guides your decision. Overvalued stocks risk corrections. Undervalued ones offer upside. For you, it helps avoid buying into bubbles.
How do you actually value Toast then? What methods?
A few key ways. Intrinsic valuation, like a discounted cash flow model, projecting maybe $600 million in free cash flow by 2026, might yield a value around $54 a share.
And comparing to others, relative valuation.
Right. Using price to sales, Toast is at 5.45x compared to peers maybe around 3x. Suggests a premium valuation.
So what's the best approach?
Probably a hybrid. Combining DCF and relative valuation, but critically factoring in the impact of that partnership-driven growth. That's a key value driver, not always caught by simple multiples.
So synthesizing all this, What's the overall investment thesis? The bear case, the bull case, and what seems most likely?
Okay, let's steelman the bear case first, the strongest arguments against. Institutional views, maybe Morningstar might say it's, say, 39% overvalued,
Why?
citing restaurant industry fragility, the high PS ratio amid potential slowdowns, competition from Square, eroding the moat, execution risks and international expansion. Some individual investors echo overhyped fears, worried about a downturn.
Plausible concerns, now the bull case.
Driven by that strong growth, 49% CAGR, this significant turnaround to profitability, and those high-impact partnerships like Dine Brands signaling major upside. Some projections go over $100, a potential 200% gain.
This is bullish.
Institutions like Seeking Alpha give buy ratings, praising the competitive advantage. Many individual investors project $60 by 2026, banking on AI and new deals.
So, weighing both, what's the most probable outcome?
Given the recent strong Q1 results and the ongoing momentum, the bull case seems the most probable right now.
And based on that, is it discounted?
Based on that bull thesis, TOST at $49.06 appears to be trading at a slight discount to that estimated $54 intrinsic value. Suggests a potential buy signal, with the partnership momentum contributing an undervalued aspect to its potential.
Okay. We started this whole conversation with a big question about TOST's accelerating partnership momentum and what it means for the future. Let's bring it all together now. Provide that pivotal answer.
Right. For you, the individual investor, the momentum from these partnerships, especially that April 2025 Dine Brands deal, the Applebee's POS rollout, the biggest ever, and that predicted potbelly tech adoption, it strongly signals TOST's decisive shift towards enterprise dominance.
It's a clear signal.
It effectively de-risks their growth path and emphatically validates their competitive advantage. They're proving they can win the big clients.
Why does that matter so much?
Because these aren't just isolated events. They are driving tangible, measurable growth. 31% increase in ARR, 25% growth in locations. It clearly demonstrates scalability within that huge $100 billion TAM.
What does the future look like then?
The outlook appears exceptionally bright. We're projecting 20-25% annual growth through 2030, propelled by continued AI innovation with TOST IQ, aggressive international expansion, still only 10% of revenue, huge potential, and landing more major chains.
High probability of success.
Very high probability, maybe 80% that they maintain leadership. Those network effects just keep it compounding.
What about the remaining risks, though?
A significant restaurant recession could stall momentum, sure, but that substantial recurring revenue, 70%, and the $1.5 billion cash buffer provide strong anti-fragility. They can weather storms.
Any final key insight for investors from first principles?
A key insight, your potential edge, is understanding the depth of TOST's fintech operations, 80% of revenue. This embedded finance, bolstered by partnerships, unlocks more advantages. Think potential loans via data, outpacing peers who lack that integration.
So what should investors watch?
Monitor gross payment volume GPV. Currently $42 billion. A consistent rise there often signals future financial beats. It's a crucial leading indicator for you.
The story of TOST really is a compelling reminder, isn't it? How strategic vision, relentless adaptation, and these powerful partnerships can reshape an industry. We've seen how their integrated approach and that expanding enterprise footprint are building a formidable position.
It's quite the transformation.
So, as you consider TOST's future, here's something to ponder. If these strategic partnerships continue to compound TOST's network effects exponentially, could it not only dominate restaurant tech, but fundamentally alter how restaurants access and use financial services globally, moving way beyond just payments?
That's the bigger question, isn't it?
What implications would that have for the broader fintech market and financial services overall? Keep exploring those possibilities.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.